As yields compress and presumably markets become more expensive, fund managers can take different actions. One of them, the contrarian, might say, hey, there's less value to be added at the moment. We should just accept that, and we should reduce portfolio risks as the opportunities decline. On the opposite end are the yield targeters. They're the kinds of people who say, well, I'm targeting 2%, and I'm going to deliver that no matter what. Now, neither of them are right or wrong. It depends on what the client actually wants or the investor actually wants. But what is really important is the investor knows what's going on and that the fund manager's actions match what they actually need. Can I give you a couple of examples of how yield targeting works? So, for example, in about 2017, RBA cash rates are around about 1.5%. They've now declined to 0.1%. Now let's imagine that a fund manager would say to their clients, we're going to try to get you that 1.5% no matter what out of government-issued securities. Well, they used to hold RBA cash in 2017, but to get those sorts of returns right now, they need to be holding something like 20-year bonds, which are obviously an entirely different kind of asset class. So let me give you another example related to credit. In about 2016, the margin over a fairly safe rate that you get from BBB securities was around about 2% per annum. That was back in 2016. Today, that figure is close to 1% over sort of risk-free levels. Now, if you wanted to continue to try to get that 2% that you had in 2016, the sorts of things you've got to do is step right into sub-investment grade credit or some pretty interesting instruments to actually preserve that. So as long as you know that's what's going on, that's fine. But hopefully you can see that yield targeting, that is trying to maintain that level of yield no matter what, makes a fund manager buy more risky things at a time when the market is offering less value, and that is the same thing as buying high and selling low. Over time, that's going to reduce your return expectations through full cycles, and it's just really important that you know that that's going on in your portfolio if that's what your fund manager is doing, and you need to ask yourself if that's the right thing for you. Is there a conflict? The first rule of risk management is simply don't take the risks that you can't afford to take. So at the extreme, there is no conflict. You simply don't take, you don't take excessive risks. Now, within that, obviously, you end up with situations where, we're trying to ensure that there's adequate portfolio diversification in place at all times. So let's say that the risk bearing that we take in our portfolios, is not extreme as a whole. But within that, we have a really good idea that we like a lot, a particular asset class that we like investing in. Let's call it corporate debt. And we like it so much that it actually starts to become a significant portion of our portfolio risk. But at some point, we're offering multi-asset class portfolios, for example. You don't want that idea to dominate the entire performance of the portfolio. So within that context, risk management is about making sure the portfolio remains adequately diversified. And at some point, in the case of corporate debt, it would not make up more than half of our portfolio risk levels, no matter what. We just make sure that those things are well balanced. Yeah, actually, there's a couple of examples. So just extending on that corporate debt example, that was a live example back in 2019. Corporate debt was actually showing some fairly good relative value over that time. We liked it a lot. There was pockets of that market that were really offering some great value. So we stepped in, we increased portfolio risk levels until it got about to almost half of our overall portfolio risk. And for us, that was enough. No matter what we saw beyond that, we would not put more of the portfolio at risk from this effectively one idea, or one broad concept. So in 2019, the portfolios were like, no further, please. And that proved to be a good thing because we unwound our positions through the rest of 2019 and went into the COVID period in great shape. There are other examples. So for example, in 2020, late 2020, we were very confident that the economy would spring out from the sort of COVID period of time. We were very comfortable that air travel would pick up again, that people would get out and drive, and things like that were going on. So we had exposures to Qantas, Brisbane Airport, for example, and Ampol, which produces jet fuel. Now, it won't take a genius to realize they're all aviation related. So we had a significant exposure to that concept within our portfolio. Again, not especially large, but we were very aware that there's an aviation theme flowing through that. So if we wanted to increase our exposure to Qantas any further, the portfolio managers were compelled to reduce their exposures to either Brisbane Airport or Ampol to some extent to make up for that, to make sure our overall exposure didn't get too much. Another area where we restrict risk, if you like, is liquidity. We like to make sure that our portfolios can move around as they need to, and clients can get their money back if they want it. So we leave really large margins for error on that front. But as we get towards the boundaries that we're comfortable with, what happens is if one portfolio manager or one asset part of the portfolio is a fairly illiquid security and they want more of it, they have to sell another thing to maintain the overall portfolio liquidity levels in place. That kind of restriction is an active position for us right now.